Hi guys, this is Sarah. Today I'm going to share with you a life hack that will save you a lot of money. And education is powerful, so I just think more people should know about this. So if you're shopping for a mortgage or you know somebody that is, my advice is to put as little down as possible. Watch to the end and you'll see why this one little change in where and when you put your funds can make all the difference. Here's why. Let's say you found a home to purchase that's $500,000. Your loan down payment options, depending on the type of loan that you qualify for, are typically 0% down, 3.5% down, 5% down, or 20% down to avoid the PMI fee, or private mortgage insurance. Let's say that you chose to put 20% down because you do want to avoid that extra PMI payment. So you have a $500,000 loan and 20% of that is $100,000 down. Here's what your loan will look like. You will have a $400,000 mortgage because you did put $100,000 down. Your term is 30 years and you have a typical interest rate as of today of about 7.5%. That makes your total monthly payment, excluding annual tax and insurance, just under $2,800 per month. And here's the 30,000 foot view of that mortgage. Now the top part is everything I just said, but notice at the bottom, if you do the standard 20% down and a 30-year term mortgage, you're going to be paying $606,000 in interest payments alone to the bank. Basically, you bought two houses, or another way to look at it is your $500,000 house actually cost you over $1 million. So you bought one for yourself and one for the bank. Now, let's say you put down as little as possible instead. Let's just say that you qualify for a 3.5% down. So that's $17,500. And here's the key part though. You do need to put the remaining $82,500 that you would have put as your down payment towards your very first mortgage payment instead of towards your down payment. So here's what your loan will look like. You'll be financing $482,500 because of your 3.5% down payment. Your term is the typical 30 years at 7.5% interest. Your total monthly payment, excluding taxes and insurance, comes out to about $33.74 per month. And that's about $576 more per month than doing it the standard way. So if you didn't take that excess money and plunk it down on your first mortgage payment, that makes this a bad idea because your payment is higher and you're paying more in interest and your total for the house in the long run is even more. But since the strategy is to do that second part, you're going to see in just a minute that putting as little down as possible saves you a lot of money and time in a very big way. So again, the key strategy here is you're putting the remainder, $82,500, down as an extra payment on your very first mortgage statement instead of as your part of your down payment. So when that happens, your PMI will immediately drop off and you will save significant money and time over the life of your loan. Here's where you'll really see the dollars and how it all makes sense. So the screenshot on the left shows the typical mortgage that people do with 20% down. And and how much you pay in interest over the life of the loan, over $600,000, and how you paid $1 million for a $500,000 property. But on the right, it shows that you put 3.5% as your down payment, and you used the $82,500 towards your very first mortgage payment. And what that does, notice towards the bottom, it reduces your term from 30 years down to 18 years, saving you almost 12 years off of the life of your loan. And perhaps even more exciting is, instead of paying $600,000 in interest, you only pay $333,000 in interest. And look at the very last line. On the first one, you don't save anything, but on the second one, you're saving almost $400,000 by using the same money you would have spent on the first one, except for you wait till the loan closes and you plunk it down as part of your very first mortgage payment instead. So education is super powerful. Now it's up to you to make the best choice for you. So which will it be? A 20% down payment, a term of 30 years with a $2,800 a month payment, and paying $600,000 in interest to the bank, essentially buying them a house plus you a house, taking 30 years to do it, and spending over $1 million in the end, or putting as little down as possible, let's just say the 3.5%, having a term of 18 years instead of 30, saving 12 years off the life of your loan, and only paying $333,000 in interest instead of the $600,000. And again, that's a savings of just under $400,000 in interest for just a few weeks difference of where you put your money and when. So, yeah, I think it's super powerful. One thing to note, if you cannot swing the higher monthly payment of $576 more per month, that's understandable. So all you would do in that case is simply crunch the numbers to have a little bit higher down payment in order to lower the monthly payment to where it feels comfortable. And yes, this will cost you more money in the long run, but at least you will have a monthly payment that feels good to you while still having a method to benefit from a significant savings of both dollars and time over the life of your loan. Well, I hope that this was valuable for you, and if so, please like and subscribe, and definitely share this video with as many people as possible so that others can save a lot of money when they are house shopping. Thanks so much.